Hello and welcome. This is June Collier from Make Your Money Work for You. Congratulations on making it to week 3, fundamental analysis. In this session, you will learn how to research a company's financials in order to determine if you believe that company is a great investment. The goal of this training is to teach you how to evaluate a company based on its financial statements. Now, why research fundamentals? Fundamental analysis is a method of examining the financial data of a company to determine its fair value by carefully analyzing the past and present performance. This fair value is then used to identify whether the company is overvalued or undervalued. Fundamental analysis is based on factual numbers. They are measurable and assess the value of a company. You can use this financial information to make comparisons with other competitors easy. Now, there are 3 main financial statements. All publicly traded companies are required to submit quarterly and annual reports to the SEC. That's the Securities and Exchange Commission. And then they detail their financial operations over the previous quarter or year. These reports are made public and are used by investors to project the likely success or failure of said company in the future. There are 3 main financial statements. The first is the balance sheet. This reports the company's assets, liabilities, and owner's equity. The second is the income statement. This reports on the company's financial performance, their revenues, their expenses, and net profits. Finally, the cash flow statement. This reports on cash entering and exiting the company. Let's talk about the balance sheet in detail. A balance sheet is more like a snapshot of the financial position of a company at a specific time. Again, usually calculated every quarter, 6 months, or 1 year. Balance sheets have 2 main sides, assets on one side and liabilities on the other. For the balance sheet to reflect the true picture, both sides should tally. Assets equal liabilities plus equity. Assets are those resources or things which the company owns. They can be divided into current as well as non-current assets or long-term assets. Liabilities are the debts or obligation of a company. It is the amount the company owes its creditors. Liabilities can be divided into current liabilities and long-term liabilities. Another important aspect in the balance sheet is shareholder or owner's equity. Assets are equal to the total liability and owner equity. Owner's equity is used when the company is a sole proprietorship, and shareholders' equity is used when a company is a corporation. This is also known as the book value of a company. Let's talk about the income statement. The income statement shows a company's profit and loss over a period of time. The profit or loss is determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. The statement displays the company's revenue, the cost, the gross profit, selling and administrative expenses, other expenses and income, taxes paid, and net profit. Finally, the cash flow statement. The cash flow statement provides aggregated data regarding all cash inflows a company receives from its ongoing operation and external investment sources. It also includes all cash outflows that pays for business activities and investments during a given period. The cash flow statement follows the cash made by the business in 3 main ways: through operations, investment, and financing. The sum of these 3 segments is called net cash flow. Let's take a look at how we analyze a company. When analyzing a company, there are a few factors to consider. The first is top-line revenue growth. You're looking to see if a company's total revenue growth is growing year over year. Next, bottom line revenue growth. After subtracting all expenses, is the bottom line revenue growth positive? Cash or assets. How much cash does a company have on hand to survive during a downturn in the economy? Debt or liabilities. How much debt is the company carrying? Debt to equity ratio. This is very similar to debt to income ratio in your personal life. The lower this number, the better. Institutional investors. Big fish move the stock market. You are looking for 70% or more of institutional investors who hold that particular stock. We are considered retail investors, but big fish or institutional investors are mutual fund companies. These are going to be your endowment companies. These are going to be your hedge funds, people that are moving the stock with billions of dollars. Price to earnings ratio. This calculates how much you're willing to pay for $1 of earnings. The lower, the better. Earnings per share. This shows how much earnings you receive per share held. Dividend rate and growth. This shows you if the company is paying a dividend, what the rate is, and if the dividend is growing year over year. Finally, free cash flow. This is cash that's available to repay creditors or pay dividends. There are several websites where you can get fundamental analysis data from. Here are just a few suggested places: finance.yahoo.com, marketwatch.com, and finviz.com. Congratulations! You have successfully completed week 3 of stock investing for complete beginners.